Okay, so today I'm very pleased to be speaking with David Flandro, who is Managing Director at Hyperion X Analytics, which is a data analytics focused entity of the broader Hyperion Insurance Group, a global broker, consultancy, MGA house, including a reinsurance broker and RKH as well. David, thank you for sparing me some time to talk today.
My pleasure. Thanks for having me.
So, in this interesting time for the industry and the world as a whole, I guess we've got to kick off with talking about the pandemic, which seems to be seems to be the topic that we're spending our time writing about, and I'm sure you're spending your
Yes.
time thinking about right now.
Right.
So, I guess let's start at maybe the beginning of the chain and think about sort of the impact to primary insurers from the pandemic and how this could maybe play into a demand for protection going forwards.
Right. Well, Steve, there are obviously multiple impacts to primary insurers of COVID-19. And I just want to say at the outset that I certainly don't want to be seen to minimize that in any way. Especially there's a huge impact to people's lives and livelihoods. And I think that it's easy as analysts when we're looking at numbers to forget that. But I haven't forgotten about it. Nor is the impact in any way negligible on insurance carriers. And I want to make sure that that's clear. That's been clear in our report from the very outset. We talk very specifically in the report, and I'm referring to the COVID-19 report that we released quite early on, a couple of weeks ago. I mean, almost any line that could be affected by contingent business interruption, especially where there's public liability or civil authority covers environmental lines, construction and engineering, energy, aviation, surety, trade credit, D&O, in addition to life, accident, and health. There are going to be effects, obviously, in all of those lines, and they're going to be large. The question is how big, and the other question is how specifically will they play out? And there is a regulatory element of this. When we look at the contracts that exist and we interpret them in a traditional way, this looks like a loss that is quantifiable. And we can quantify it, but we can start to quantify it anyway by line of business. When you throw in a potential structural or regulatory change, it's much harder to predict. So we are still, alas, waiting to see what happens on the regulatory front. But in terms of the losses themselves, they're not going to be particularly small, but without acute regulatory intervention, we don't see it as a record-breaking loss. Now, again, that really depends on how you measure it. Is this going to be measured against Hurricane Katrina as a single and distinct loss, or are we measuring it against the liability crisis as a series of losses from multiple business lines? That all needs to be analyzed. And then the other thing is we've only so far talked about the first facet, which is technical earnings. Mm-hmm. The second facet, of course, is the asset side. And the asset side, a week ago, I would have said quite clearly that the asset side would be the biggest effect on insurance carrier balance sheets from the loss. Of course, since then, maybe 2 weeks ago, we've had something of a recovery in asset prices. Will that persist? What will it look like on June 30th? What will it look like on December 31st? We just don't know yet. But we do know that there has been an increase in yields on high-grade fixed income securities and a decrease in equity prices, commodities, clearly real estate and other things. So there will be an asset side effect. And then the third effect that you mentioned, of course, Steve, is the top line. And for primary carriers, and not just primary carriers, but the risk managers at corporations who buy insurance, clearly this just cannot be overstated. What's happening in the global economy is acute, it's significant. Certainly in the short term. In the report that we published, we talk about three different scenarios: V-shaped, U-shaped, and L-shaped. And we cribbed that from the Harvard Business Review, but I think we were early in the insurance industry to be looking at scenarios. We think we're going to be in a prolonged U-shaped recovery with all the implications that will have for top lines, particularly for pro-cyclical carriers. And so you're going to see in that instance, longer term, an inflation of loss ratios because of lower top line growth, certainly for carriers that are correlated to economic growth. All of that together, all of those moving parts together have to be analyzed rigorously to understand the effect just on the primary sector. We've had a lot of people talking about things in hyperbolic terms, and that's fine. I think that we need to see more analytical rigor. I want to see tables with lines of business delineated, maximums and minimums, and I'd like to see how that affects the loss, how it affects premiums, and how it affects capital.
Yeah. Yeah, that's a really good point as well, because I think with every report I see over the last sort of
Yeah.
month, I suppose there's a new line of business mentioned as somewhere that losses are going to fall, and this is what 6-8 weeks into the crisis part of the pandemic.
I blame journalists personally.
Of course, it's always our fault. But where will we be in 6 months' time, and how many lines of business will we find that claims have fallen to? And as you say, on the asset side, it's interesting how that will affect capitalization and solvency ratios, and what that could do for demand for buying reinsurance as well. There's so many factors that are going to play into this over the rest of this year, I suppose.
Yeah.
So what do you think's the going to? I mean, it's really hard to answer, I suppose. But is it the asset side and the ongoing volatility there, or is it the eventual slow build up of claims and the potential tail of claims as well? I mean, people could be paying losses from COVID for potentially a decade or more.
It's changing daily. And as I said before, on the asset side, right now, if we were to take the impairment in asset values that's taken place on the high grade, medium duration fixed income side, as well as the equity side, even though the sector's equities gearing is lower than it was, we would have an equity haircut at the end of the year somewhere in the high single digits. Today is April 23rd. December 31st is a long way away. So for 2020, is that going to be the definitive effect on the asset side? We just don't know yet. 2 weeks ago, I would have said, given what we had been going through at that point, that the asset side effect on insurance carrier balance sheets would have been the largest. And I still think there's a very good chance of that, depending on how the crisis plays out. But clearly, there are going to be technical losses coming through from this. And as I said, they're not going to be small. The real question, though, is will they be record breaking? Are we looking at loss ratios of 120%, or are we looking at loss ratios of 80 to 85%? And I'm still erring towards the latter personally, unless, again, there is some significant change in contract law that I'm not personally anticipating. So the answer is I don't know, because we're too far away from the end of the year. To me right now, though, I wouldn't underestimate the effect on the asset side. And the really important thing, of course, is that wherever the loss is coming from, it's important to insurance carriers' capital positions. It affects their ratings, it affects their economic and regulatory capital, and it affects the shareholder value associated with insurance companies. And heaven forbid, it could affect claims paying ability. We still don't see that yet, except in some cases where the carriers were already in trouble to begin with. The thing that I have said from the beginning of this is that I am pretty confident in the insurance sector's ability to trade through this. I would now qualify that and say that if governments decide that contract law shouldn't be honored, then all bets are off. But going into this, we were far less leveraged to structured assets than we were going into the financial crisis. And the sector's balance sheet was at record capacity going into this. So I'm still confident that we will trade through this, and the insurance sector will be a great benefit to the global economy as we make our way through this.
Sure. Okay, thank you. So if we move forwards along the chain slightly up to the reinsurance market, right. Obviously yes. that is also going to face claims from multiple lines of business, but then we have other areas such as aggregation and proportional versus or quota shares and things like that, where claims could fall into. I mean, it's going to be interesting and take a long time to really understand the impact to reinsurers and by definition the ILS market as well. But where do you see the biggest potential pain points? I mean, obviously everyone talks about BI and the legal action that's ongoing, but actually is trade credit going to be a bigger issue potentially for certain areas of the market? Or
Oh, there's no doubt that trade credit is going to be very important, and trade credit reinsurance is an important line for many specialty reinsurers. So that's certainly an area where that will experience losses. I have no doubt about that. And you're right to point out the difference between proportional and excess of loss. If you have reinsurers that are underwriting proportional covers with insurers in pro-cyclical or affected lines, obviously those lines of business will be among the first to be affected, and trade credit is one of them. You know, aviation, particularly airline, is another. Construction and engineering is another. These are all specialty lines. D&O is another. Comp is one that we're thinking about pretty carefully, and we talked about that in our report. That is all true. Also, E&S markets are interesting to review in the United States. That is all important. The broader picture, though, if you're comparing reinsurance to insurance, is that if you had to compare the two directly, reinsurance is still more countercyclical than primary insurance. And I think that, you know, you could see this at the 1/4 renewals. Clearly, people were talking about COVID-19. And of course, people will talk about COVID-19 at the 1/6 renewals. But there are still broad structural factors, big tectonic plates that are in place in the reinsurance sector, particularly in CAT, where the catastrophe loss experience of 2017 and the subsequent development, the Japanese typhoons that we've seen over the last few years and their development, and everything that has been happening with dedicated reinsurance capital in the ILS market and elsewhere cannot be ignored or set to one side. Those will also play a big factor in upcoming renewals. And I think that reinsurance renewals will look more similar to how they would have done than perhaps some pro-cyclical insurance renewals. Right. I'm sorry to be so technical. But
no, that makes a lot of sense. There are a lot of factors that are sort of coming.
Well, it does to you. I hope it does to everybody listening.
And then if we move forwards to retrocession as well, I mean, this is a really, again, a very challenging area to identify how it will be impacted. And I know there's a lot of nervousness around the potential for claims to flow down the line and end up sort of coming into some retrocession areas of retrocession. But is this largely going to be a case of sort of wordings really mattering through the different tiers in the market? Is that what's going to drive losses through, or is there somewhere that you see broader impacts?
There may be those who are more knowledgeable about this than me in the market, but for me right now, it's too early to tell. We're looking at everything case by case and contract by contract, and it's a wait and see for us right now.
Sure. No, I think it probably is for most in the retro market as well at this stage. It's still early days for the tier above them.
So I wouldn't want to say anything too definitive, certainly.
Of course. So if we move on to the ILS market and the collateralized products that are in the market and things like catastrophe bonds, I mean, what are your thoughts on the prospects for those markets going forwards? I mean, obviously we've had an interesting month of trading in the cat bond market. We've had some investors again turning to ILS as a source of capital and liquidity when they really needed it, which is some people would see as people withdrawing from the sector, but actually is very positive for those investors that they have somewhere they can call on liquidity. And then at the same time, we also have rates definitely rising quite significantly in cat bonds and looking quite positive for investors. I mean, what would your view be on that sector?
Okay, well, as you can see here, I'm looking at my computer screen, looking at the Swiss Re US Wind Cat Bond Price Return Index, or trying to. But this is an interesting time for catastrophe bonds. Our metal is going to be tested. Investors' metal is going to be tested, and the ILS market is going through the biggest, or at least the capital backing the ILS market is going through the biggest shift, obviously, as it has since the financial crisis. But it's an interesting time, and we are finding investor demand for various products. One of the things that's really interesting right now, of course, is that before we talk about just the cat bond market, you have to think about third-party capital and all of the other things that they invest in: oil and energy, real estate, equities, low-grade fixed income securities. All of these things, if you have a 401k or if you have a pension or a SIP, all of these things have been impaired significantly. It's no different for teachers' retirement funds and pension funds and others that invest in ILS markets. And so you might think, well, everything is correlated in the tail, and there may be less appetite for collateralized investments. On the contrary, we're finding that a couple of things are happening, and this is just my experience, but investors that are endeavoring to be more opportunistic, if you're looking at negative oil or you're looking at low real estate prices or equity prices and you want to get back in, you need to have something that hedges your Sharpe ratio. And what that just means is that investors are measured by their average return divided by standard deviation, which is a function of rho. Okay, and if you have a small proportion of investments that's non-correlative and relatively high yielding in your portfolio, it can hedge you or enable you to invest in other stuff. So in fact, no, I don't think this is diminished appetite for ILS very much at all. I think people are in fact looking for, and we are getting new investors who are looking for non-correlative assets that are relatively high yielding in sectors where rates are going up. And prior to the crisis and at 1.4, that is what we've been seeing in the reinsurance market. So there seems to be pretty healthy investment appetite for alternative capital products, even products that are just non-cyclical rather than non-correlative. So it doesn't seem to me that appetite has diminished particularly in any way. And it's probably because ILS typically represent a fairly small proportion of broader pension fund, hedge fund, and sovereign wealth fund assets.
Yeah, yeah. No, that's my experience as well since this all began. There's a lot of new investors reading Artemis, thankfully, which is always good. But they're also reaching out, and they have a lot of very good questions about the space. So they're clearly looking to learn and watching closely and looking for opportunities.
That's right. Yes, that's right. So as you may know, I've spent a long time talking to the sell side, and I used to work on the sell side, and so I know some of the guys on the buy side and gals, and there is a heightened interest in alternative asset classes, especially people coming to me and asking, how does this work? We've had a lot of those conversations over the last few weeks. Maybe it's just because people are sitting at home and they just want to chat, but I've talked about it with people a lot more than I have before.
Sure. And of course, that brings us on nicely to Hyperion has partnered recently with Vario Partners to launch a collateralized whole account reinsurance offering, which is going to be backed by insurance-linked securities, in some cases at least. Can you tell us how that's been received by the market? Obviously, the timing may have been relatively good for that because it's the kind of product people are maybe interested in from a hedging point of view right now.
We certainly hope so, and our goal with this is to be part of the solution for insurance carriers who are looking for capital that is competitive and efficient. So yes, whole account stop loss cover, whole account stop loss reinsurance is something that's pretty rare in today's market. So being able to go into the market and offer whole account collateralized stop loss cover, it is attractive. And it's attractive for a few reasons. First of all, the product is based on a calendar year earnings trigger, and it's based on technical earnings. So that in and of itself is interesting to investors because technical earnings, even though they are somewhat cyclical depending on the line of business, they're not as cyclical as a typical investment in an insurance company. So that makes it interesting to investors. But for the issuers, the benefits, I think, are 3 or 4-fold. First and foremost, this lowers capital charges for things like volatility risk, some counterparty credit risk, and some other risks, number one. Number two, it lowers your forward discount rate because if you can tell your investors, listen, we're not going to lose money on a net basis on the technical account above a certain loss ratio, well, that can have positive effects on franchise value. So that's another area. And then third, Rating agencies will never give explicit credit for this, but again, if you can tell them our technical earnings are protected, uh, depending on what you spend to do it, it must have a net benefit if you are limiting your losses above a certain loss ratio. Finally, the other important thing to realize is that costs of equity are increasing. I mean, if you look at the insurance sector, the average decline in share price for the insurance sector is 30 to 40%. That's not too far out of whack with the rest of the market, but it is a little bit higher. So costs of equity in terms of how you calculate cost of equity, if you want to use a 52-week beta against the FTSE 100 using the capital asset pricing model, your WACC might be around, or sorry, your cost of equity might be around 10. Costs of debt have gone up. Senior debt and subordinated debt funding costs have increased. We've seen that. They spiked up pretty high a couple of weeks ago, and then they've settled, but we're still 150 to 200 bips higher for a lot of securities than we were. So debt financing costs are higher. Retro costs are higher. You know this. Of course, the Hyperion X global risk-adjusted retrocession rate on line index was up 20% at January 1st, and we don't really see any reason for it to fall at the moment. So retro costs are higher and reinsurance costs are higher. We saw that at 1.4. So if you're in that environment of higher capital costs for almost every form of capital, and you can get whole account stop loss reinsurance cover on a collateralized basis that's competitive with your previous funding costs for debt, it is a boon to your capital structure. It's a boon to your franchise value, and it's a boon to regulatory capital. So we've seen a lot of interest. It is a product that we hope can provide a good solution, and we're moving forward with it on several fronts.
Good. No, it seems like at this point in time, it's potentially a very valuable product to people whose balance and liabilities sides are going to be shrunken slightly.
That's why we wanted to bring it to the market. We want to be part of the solution.
Yeah, no, that's great to hear. So I guess one final question, one that I skipped over from earlier on. What other sort of opportunities do you see in the broking world for companies like Hyperion and Hyperion X specifically? What are you guys going to be focused on to provide more solutions to help people out of the current crisis?
Well, that's a good question. And what I would say is that the current situation is simply accelerating trends that were in place beforehand. You've heard me banging on about acquisition cost ratios and how the acquisition cost ratio in Lloyd's is 10 percentage points higher than it was back in 2005 and all that good stuff. And not just Lloyd's, but globally in the sector, the trend is the same. One of the things that we're doing in Hyperion X is we're trying very hard to create better solutions for people using technology and electronic trading. And I have to say, one of the most exciting things that's happened in the last few weeks has been looking at the X-Trade digital marketplace. And you may have seen that we launched TEPFIN X yesterday. The reason I know it sounds like an advertisement, and it is, but the reason I want to talk about it is that it's significant in the context of the sector. When Paul Hillier and I and Barnaby Rudder-Price and the rest of the Hyperion X team were looking at the numbers, we had to take off our glass. I had to take off my glasses because the increase in volume on the portal, on the broker portal, on the cargo portal, on X-Trade Sports, and on TEPFIN X has been so acute that we just couldn't believe it. People are using online and digital trading platforms to trade particularly wholesale risks more efficiently and with lower acquisition costs and more rapidly than they were pre-coronavirus. There's no other way to say it. So I think what's happening here is that COVID-19 has created an environment in which new solutions are needed to trade, and where we were trying to create those solutions beforehand, and I think that the effect of these is benevolent. We're lowering acquisition costs, creating more market transparency, and creating more volume. Now that people need a way to do this in the current situation, they're finding that this is a great way to go about it. So if I was going to answer your question in any way, as a broker, this is an area where we feel like we've really been able to help. And it's exciting, and it has been accelerated during the current situation.
Yes, no, I'd agree. I think people are pushed into a strange new world with sort of world-changing crises like this, but actually the insurance and reinsurance industry is very good at adapting despite the fact we all
Yes.
talk about how old-fashioned it can be and the relationships that matter, actually the industry is still very good at adapting to a new normal like this.
When we need to, we can come to the
Yeah,
table, and we're doing so.
absolutely. Okay, great. No, thank you very much, David. I
All right.
appreciate your time today, and I'll look forward to talking
Pleasure.
to you again soon.
My pleasure, Steve. Take care.
Thanks.